That's how you get another not-so-hot day, where the Dow dipped 9 points, S&P shed 0.16%, and the Nasdaq fell 0.35%. Drib, drab, down. Like I've said before, 2011, the last real bad debt ceiling fight, gives you a good playbook for the current moment. But there are also some big differences. In 2011, it was a horrendous period full of idiotic partisan bickering. However, there was a scintilla of good faith on both sides, and we ended up with a painful budget compromise.
The House of Pain.
That everybody could live with, even as nobody was particularly happy with it. This time, it feels like the Republicans will be fine triggering a default that might lead to recession, because that could crush Biden's chances of re-election next year. Meanwhile, the Democrats don't want to negotiate at all. They think they can successfully blame the GOP when your Social Security checks stop coming. None of our leaders seems worried about what will happen if the government can't pay its bills, because both parties are convinced the other side will take the blame. In 2011, there was actually what I call a mutually assured destruction, MAD. Both sides knew they had to blink or else. This time we don't have anywhere near that urgency. But maybe the politicians will change their tune once we get closer and closer to the deadline and big business starts freaking out. Now, in the end, I still think President Biden has to compromise because he wants to get reelected. No sitting president wants to be on the hook for messing up with Medicare or Social Security in an election year. That's why I think Treasury Secretary Janet Yellen may be trying to set up a gigantic credit line with America's most solvent banks to cover Social Security and national debt claims for a couple of weeks until they get this worked out. But what does it mean for you? And that's what I care about. First, if we're reliving 2011, you need to have a little more cash than usual. That's what I've been saying. Back then, we fell 19% from peak to trough through the difficult negotiations, followed by a ridiculous debt downgrade from Standard & Poor's. I know I'm starting to sound like a scold about this, but it could be even worse this time because there is zero good faith, and the Powells don't even seem to be taking it seriously. It's like they want it to happen. When will this all occur? I think it could be sooner than the last week of May, which is what people are looking for right now, because tax receipts from the IRS were weaker than expected. So this weekend, we'll hear more details about default plans and what they look like, plus dreadful rhetoric about each side and how they actually don't want to default. Ha, ha, ha. We also have to deal with the possibility of another regional bank getting seized by the FTC to prevent a run. No need to single one out. It's the usual California bank run suspects. The FDIC is so clueless. They could just pull the plug on a bank without any notice. So in keeping with the confines of our game plan, on Monday, we find out how much further apart the two parties are and which bank, if any, is in receivership. Tuesday, though, we go back to our regularly scheduled business programming with the stock of Home Depot. Home Depot's reporting. Earlier this week, I told you there's a lot of professional refurbishment going on. Maybe that cuts well for Home Depot. But I'd like to hear a candid discussion about theft. Pilferage, yes. I want all retailers to own up to how bad things have gotten, not just the drugstore chains. And then maybe we can change something. The best quote of the week, I think it's going to come from On Holdings. That's that Swiss sneaker company that's been growing like a weed. Roger Federer's in there. I like the fact that this company got to $1 billion in sales much faster than Nike did back in the day. This company's the one to watch. We also get retail sales on Tuesday, and we might see some real cracks in consumer spending related to fears of both the recession and a lack of federal payments from the debt default. Yes, the ramifications are that obvious. Why do I know that? Because that's what happened in 2011. To make things more miserable for the bulls, we have two unreconstructed hawks from the Fed talking. We've got Loretta Mester, and she's in the morning, followed by John Williams in the afternoon. While their hard line on inflation and the need for more interest rate increases made plenty of sense a few months ago, it's downright dangerous now that we've got a bank run and debt to stand off. I mean, come on, guys, look at the headlines. Wednesday morning, we get a read from Target, which has been struggling of late, only because we're in a very difficult moment for many of their aisles, especially the ones that are carrying hard goods, which aren't selling well. It's become too hard to predict how well this kind of retailer might do when the environment's so tricky, even though it's so well run. I don't feel that way about TJX, so the off-price chain we own for the Chapel Trust that does best when stores like Bed Bath are closing and people want to trade down to cheaper but just as good merchandise. After the close, we get results from Cisco, and the giant networking play should have a good quarter. But it's become hopelessly out of favor with the analyst community. Cisco reported an excellent quarter last go-around, but it was panned anyway. That's just living off its backlog without new orders coming in. Next, I'm getting a sense that Take-Two Interactive, that's the video game maker, might be due for a, let's say, a change of fortune. Last time around, CEO Strauss Zelnick came here, right here, and told us he was not happy with his own performance. You know what? I don't see that happening again. Now, of course, we'll be covering all these issues, especially TJX, at the Investing Club monthly meeting. A lot of you got some very nice notes this week about what we're up to at the club. I am informing you of this because I think you will enjoy it and you should sign up. We might have good news Thursday morning. That's Walmart and Alibaba's time to shine. Now, Walmart stock has been meandering higher, and its Walmart Plus service is starting to really gain some momentum. That's a recipe for some better-than-expected numbers. I like Alibaba going into the quarter because China wants to unload more IPOs on our markets, not theirs. So why wouldn't their government help Alibaba have a surprise profit? It's the most powerful dictatorship in the world. You really think the Communist Party can't put their thumb on the profit scale? Speaking of China, Applied Materials, the semiconductor equipment maker with a substantial Chinese business, reports that evening. And I wonder whether that'll put a damper on results that might otherwise begun to show momentum now that the semiconductor inventory glut for so many different industries, even PCs, could be running its course. Finally, on Friday, Jay Powell, the Fed chief, participates in a panel about monetary policy. Now, this man got horse sense. I think he'll acknowledge that, I like that new word, acknowledge that inflationary numbers have to be balanced with the debt ceiling fears and say the Fed has to wait and see what the partisan rancor might mean in terms of consumer and corporate credit and your spending. Hopefully, he'll also talk about the bank runs and the possibility of a credit crunch because of them. Because I want him to understand the whole mosaic of what's going on, not just some number from a producer price number, for heaven's sake, even though that was good. We got two big reports on Friday, too, Foot Locker and Deere. Now, we got a small position in Foot Locker for the trust. We want to get bigger, but because we think Mary Dillon, the new CEO who previously turned around Ulta Beauty, is now in the process of turning around Foot Locker. But it's going to be a long turn. While this should not be a particularly important quarter, we like the 4% yield because they're paying you to wait until she does get it together, and I think she will because I think she's so amazing. Finally, there's Deere, which trades as a function of crop forecasts. We don't know how things are shaping up, but we do know agriculture is fickle. So it's best to keep your bat on your shoulder and wait for better, less dicey times. That's certainly a possibility once we get this debt ceiling fixed. I'm going to be drilling down on it because I do like the stock down here. But the bottom line, I doubt we'll fix the debt ceiling crisis next week, so steel yourself what could be, yes, indeed, as per the 2011 playbook, another difficult week ahead of us.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.